Index funds versus stocks. Which is better for beginners? Investing is one of the most powerful ways to build wealth, but for beginners, it can feel overwhelming. You've probably heard about stocks and index funds, but which one should you choose? Should you invest in individual stocks, picking companies like Tesla, Apple, or Amazon? Or should you go the safer route and invest in an index fund, which includes hundreds or even thousands of stocks? In this video, we're going to break it all down in simple terms: what stocks and index funds are, their pros and cons, and most importantly, which one is best for you as a beginner. So, if you're serious about investing and growing your money the smart way, stick around. Section 1. What are stocks? First, let's talk about stocks. A stock represents ownership in a company. When you buy a stock, you become a shareholder, which means you own a small piece of that company. For example, if you buy shares of Apple, you technically own a part of Apple. If Apple does well, releasing new iPhones, increasing profits, and expanding globally, its stock price goes up, and you make money. But here's the catch. If Apple faces problems, like declining sales, lawsuits, or economic downturns, its stock price can fall, and you might lose money. That's the risk of individual stocks. Stocks are powerful because they offer high potential returns, but they require research, patience, and risk tolerance. There are also different types of stocks, such as growth stocks. These are companies that reinvest profits into expanding their business instead of paying dividends. Think of Amazon, Tesla, or Netflix. Dividend stocks. These companies pay you regularly just for owning their stock. Companies like Coca-Cola and Johnson & Johnson are known for paying dividends consistently. Blue chip stocks. These are well-established companies with a solid history of stability and profitability, such as Microsoft, Berkshire Hathaway, and McDonald's. Section 2. What are index funds? Now that you understand stocks, let's talk about index funds. An index fund is like a basket of stocks. Instead of picking individual companies, an index fund automatically invests in many stocks at once. For example, the S&P 500 index fund includes the 500 largest U.S. companies, like Apple, Google, Microsoft, and Amazon. Instead of betting on one company, you're betting on the success of the overall market. The best part? If one company in the fund struggles, the other companies help balance it out, reducing risk. There are different types of index funds, such as S&P 500 index funds. These track the top 500 companies in the U.S. and are one of the most popular choices for investors. Total stock market index funds. These invest in the entire U.S. stock market, including small, medium, and large companies. Sector index funds. These focus on specific industries like technology, healthcare, or renewable energy. The biggest advantage of index funds is diversification. Instead of putting all your money into one company, you spread it across hundreds, making it a safer long-term investment. Section 3. Pros and cons. Now, let's compare the pros and cons of stocks and index funds so you can decide which fits your investing style. Pros of stocks. Higher returns. If you pick a winning stock like Amazon or Tesla early, you can multiply your investment significantly. Some stocks have grown by thousands of % over time. Dividends. Some stocks pay regular cash payments just for holding them, which can provide passive income. More control. You get to decide which companies you invest in and can take advantage of opportunities in fast-growing sectors. Cons of stocks. High risk. Stock prices can be unpredictable. If a company underperforms, you could lose money fast. Requires research. To succeed with stocks, you need to study financial reports, understand business models, and stay updated on market trends. Time-consuming. Unlike index funds, which you can buy and forget about, stocks require constant monitoring. Pros of index funds. Low risk. Since index funds spread your investment across many companies, they are much safer than investing in a single stock. Easy to manage. No need to analyze financial statements or follow market news daily. Just invest and let the fund grow over time. Consistent returns. Historically, index funds like the S&P 500 have delivered average annual returns of 8 to 10%, making them great for long-term investing. Cons of index funds. Lower returns. compared to winning stocks. While index funds are safe, they won't give you huge overnight gains like an individual stock might. Lack of control. You can't pick which companies are included in an index fund. If you don't like certain companies in the fund, there's nothing you can do about it. Section 4. Which one is better for beginners? So, which one should you choose as a beginner? If you want high potential returns and are willing to take risks, stocks can be a great option. But you need to do your research and understand the risks involved. If you prefer a safer, hands-off approach with steady long-term growth, index funds are the way to go. They provide diversification, require less effort, and have a solid track record of returns. In fact, even legendary investor Warren Buffett recommends index funds for most beginners because they outperform most actively managed investments over time. Section 5. How to get started. Getting started is easy. If you want to invest in index funds, open an account with Vanguard, Fidelity, or Schwab, and start with an S&P 500 index fund. If you want to pick stocks, use platforms like Robinhood, eStarTrade, or TD Ameritrade, research companies, and start small. Now that you know the difference between stocks and index funds, which one will you choose? Let me know in the comments. If you found this helpful, hit the like button, subscribe, and turn on notifications for more investing tips. Thanks for watching, and I'll see you in the next video.